Howdy friends, Joel Garris of Nelson Financial Planning here on Dollars and Cents on News Radio WFLA. On this segment of the program, we're going to tackle the question of what's the biggest mistake that 40-somethings are making with their retirement. And when you look at the numbers, it's actually pretty staggering when you look at the percentages of 40-somethings that are doing this, that is just absolutely ruining their retirement. And what is it that we're talking about? Well, nearly half, 46% of 40-somethings actually take money out of their retirement accounts. That's a pretty staggering number, and certainly one that is fraught with not just tax implications, but investment implications, retirement implications across the board. It's just too easy sometimes to grab money out, and if you're doing that and you're doing that before 59 and a half, the cost is just tremendous, right? Because when you take money out of a retirement account, that's taxable. And what's happening then is when you report that taxable income basically winds up coming in at your highest taxable income bracket, right? Because you still sort of made your normal income, but then you took money out of an IRA or 401k, and now that is extra income that goes onto your return, so that's all going to be taxed at the highest marginal rate. The other important consideration is that, again, you're not 59 and a half, so that's probably going to be subject to a 10% penalty for that early distribution. So now you've got taxes, now you've got 10%. It's not uncommon that the total amount of taxes that you have to pay add up to at least a third of the amount of money that you took out. I don't know about you, but a 32% or a 33% tax rate on anything is a pretty high interest rate to apply when you're trying to use money. The exceptions, there are some exceptions to avoiding that 10% penalty: first-time home purchase, medical, things like that. But the reality is that beyond just the tax cost, which is a significant chunk, you've got the opportunity cost, right, of that money that could be invested for another 20 years. We'll give you a very simple example with some numbers. So let's say you took $5,000 out for a down payment on your first house. Okay, so you took $5,000. The reality is that it was a first-time home purchase. So okay, fine, you were able to avoid the 10% penalty, but you still were in the 22% tax bracket. So you had to spend $1,000 to get that $5,000. If you have that $5,000, the opportunity cost on that, remember, if we use just sort of a 7% growth rate, which is comparable to what the markets typically have done over a long period of time, then that $5,000 over a 10-year period of time is going to turn into $10,000. And then over a 20-year period of time, that's going to turn into $20,000. So that $5,000 that cost you $1,000 in taxes when you did it, also you lose the opportunity for that money to continue to stay invested and continue to grow. And over a 20-year period of time, if you're in your 40s trying to retire by the time you get to your 60s, that's certainly 20 years. That has the potential to be equivalent to $20,000. If you're in your early 40s and thinking it's more going to be back in your 60s before you retire, well, that's 30 years, and now that $5,000 that you took is now worth $40,000. So understand, it's not just about the taxes that chew away immediately when you take money out of a retirement account, but it is also that opportunity cost that can be much more significant, particularly if you're in the group of folks that are using their retirement accounts at their early 40s. That's clearly the single biggest mistake that 40-something-year-olds are making with their retirement, particularly when you consider that nearly 46% of those in that age group are in fact doing that. So A loan is a little bit better option if you've got a 401k because you avoid the taxes on it, you avoid the penalty on it, but you're then just wind up replacing that money through those loan payments. And so what that means is that that's better because you avoided the upfront tax costs, but you still miss out on the opportunity costs to have that chunk of money continue to be invested in your account. So it's certainly important to be able to make sure that you are not just paying a bunch of money in taxes, but also missing out on the opportunity cost. So obviously, in light of today's pandemic, that everything sort of has gone out the window, making it very difficult for folks to be in good financial shape. So understand if you have to do this in light of what's going on. The folks in Congress have actually made it a little bit easier. They waived the 10% penalty if you're using retirement dollars for your financial support because you've been affected by COVID. But just understand that it is quite costly, whether it's the taxes, but also more importantly, I think the thing that people sort of forget is the opportunity cost. If you're in your 40s, that money can stay invested, can stay growing for another 20 or 30 year period of time. $5,000 over 30 years, potential to be $40,000. That's a tremendous difference in what your retirement picture looks like. So make sure you've explored all possible options before you hit your retirement accounts, whether that's trying to work with your lenders. I think next week on the program, we're going to be talking about some of the financial strategies you can do to try and reduce down your current expenses, and also some of the things that you can be doing to help put yourself in better financial shape to sort of get through this period of time. But the bottom line is that once this period of time passes, one of the things that we were going to urge folks to really do and to take some time to do is to really start an emergency savings account, right? Make it 3 months, better if it's 6 months, but certainly the notion of having an emergency savings account is pretty important because it's that type of an emergency savings account that will in fact get you through unexpected periods of time like what we're having now. So certainly if you've been affected, you don't have much choice. The reality is, though, that you really want to turn to your retirement accounts as the last possible option, not just for the tax costs, but also for the opportunity costs. And even before, the statistic of that we were quoting of 46%, nearly half of all 40-something-year-olds taking money from their retirement accounts, that was a survey that was done earlier in the year. So long before any of this coronavirus stuff had come to pass. So the bottom line, though, is once this situation passes, then to really focus on making sure that you've got some kind of an emergency savings account built up so you don't have to go through that process. That was something that nobody was really doing, particularly when you look at the statistics where nearly half of all 40-something-year-olds were using their retirement accounts to help fund just normal expenses. So the cost is very, very high, whether it's your tax cost or whether it's your opportunity cost. So you've really got to figure out a way, particularly once things return to normal a little bit more, is to really look at ways to build an emergency savings account so that you've got money that you can access, that you can use, so that when these times come, that you don't have to hit the retirement accounts, because it's just too easy to do that. It's way too easy to do that, and at the end of the day, you just sort of only see the tax costs, which is something that you would see, by the next tax filing deadline, but you don't see the opportunity cost, and that opportunity cost of that money to grow compounded over a 20 or 30 year period of time becomes a tremendous hit to your retirement. So certainly something to think about. Hopefully folks can avoid that very common mistake as it relates to your retirement accounts, particularly if you're in those younger age brackets. So anyway, we will wrap it on up and get on out of here. And thank you all so much for listening to the program. And we'll of course be back next week on, I guess that's coming up very soon, back half of May, here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando.